We'll get to the debt ceiling in just a second, but just react in real time, if you could, to what Jamie Dimon's saying at the Investor Day. I know it's difficult for you, same company. However, Fed funds going higher. The message is be prepared for interest rates going higher.
So we were thinking there was a chance of that happening before March happened. So I do think Fed officials had also said that there was some upside to their 5.1% midpoint forecast before then. But we've now added the second way of breaking economic growth and inflation through credit tightening. So now we do feel fairly confident that May was the last rate hike and that the next move will be a rate cut. I think as a risk manager, bank CEOs, other CEOs need to deal with multiple scenarios and multiple possibilities to stress test their portfolios. But thinking about economic fundamentals, we do think the direction of travel here is really for lower yields. And this recent move higher, the 30 basis points we've gotten over the last couple of weeks in the 2-year, the 10-year, it's a gift. It's a gift to add duration again and to be able to benefit from locking in these higher rates and capital appreciation rather than sitting around in too much cash, which has seen $800 billion of inflows this year and is a dangerous place to be going forward.
So one gift in one part of the market can be a potential problem in another. Is it a problem for equities if rates continue to go up? And if those kinds of comments that we heard here are a reminder that the Fed might be far from finished?
So I do think if yields continue to move higher, you might continue to see some pressure in some parts of the market. You started to see that last week with defensives. We think that's one of the reasons utilities, for example, had a negative return last week of 4%, was the fact that you had a 30 basis point move higher across the yield curve. But ultimately, our view is that's kind of capped. Everything we hear from investors is how bonds are back and everyone is waiting for these move higher in yields to add duration. So there's a cap, there's a limit to how much higher yields go. And we do feel comfortable adding duration, but also having exposure, especially to defensives within the equity side.
But see, even if rates are done, let's say, going up from here because of the 30 basis point move, if they sit here, the competition that presents to equities remains. It just doesn't become even more dramatic, right?
Absolutely. And we do think the excitement for us, especially on the U.S. side, is really in bonds. It's in fixed income this year. There's just so much to be gained from locking in these yields and from the potential price appreciation as yields continue to fall. You could be talking about over the next 12 months, high single-digit returns from boring things like treasuries and investment grade if you're extending duration at this point. Within equities, that's why that leads us to a lot more enthusiasm, I would say, overseas. Especially, we wouldn't snooze on the positive developments in Europe, in Japan, and our expectation that emerging markets as well starts to turn around. And flows are really reflecting that, right? You're seeing outflows from U.S. equities this year, inflows into international equities, fixed income as well.